News crossing moments ago on Boeing, S&P Global Ratings placing the company on credit watch negative over increased financial risks related to the ongoing machinist strike, now in its fourth week. And joining us now is Sheila Kahyaoglu from Jefferies. Sheila, this I suppose is expected. We know that the strike is still going on, but how dangerous is it for the stock?
I mean, we've been expecting, some changes with S&P given what Moody's had done. We actually hosted a call with S&P today, and what S&P is looking for is cash break even in 2025 at minimum. That wouldn't really hold their rating. We're forecasting about $3 to $4 billion of cash next year, given they're going to lose $10 billion of free cash flow in 2024. The strike actually is not impacting Q3 cash flows as much as we expected because Boeing deliveries came out this morning. And they delivered about 27 MAXs versus 31 in August. So it wasn't as bad as we expected. They delivered 10 since September 13th, which is the day the strike started. But Boeing's cash position is still on shaky ground.
Okay. So at what point do you think the strike lengthwise becomes a real big problem for investors, even at the level the stock is trading at now?
I mean, it is an issue. I think we're looking at an equity raise. Given Boeing ended Q2 with $12.5 billion of cash, we have them losing $4 billion of cash in the third quarter. That takes their cash balance down to around $8 to $9 billion. We don't have a strike impact yet in Q3, but we'll see it in Q4. Every month is about $1.5 billion of free cash flow outflow, so that puts them below that $10 billion threshold. We're looking for a $10 billion raise. Some investors think it's bigger than that. I just don't know if the market has the appetite. And every $5 billion of equity raised is about $12 diluted to the share price. So we're expecting that. The market is expecting that. It's just a matter of when the strike is resolved. But I don't know if anybody has any insights on that.
Sheila, I mean, the stock's down so much. It's something like 40% since the start of the year. Do you buy here? I mean, what does it take to actually see a true meaningful turnaround happen in the stock? Because we've been having issues for years now.
I get reminded of that all the time, Morgan. Thank you for that reminder once again. I think our target price is $240. It's based on a normalized, semi-normalized free cash flow number in 2026. We're still giving out tons of concessions. We have $58 billion of debt on the balance sheet, a potentially equity raise, a strike ongoing. There's a lot of things that could go right for this company, but there's also a lot of things wrong. The best way to hedge it is continue with the aftermarket plays. We've been pitching GE, HEICO, stocks like FTAI as well, in terms of positive aftermarket companies in the sector.
Yeah, and certainly those companies have had really strong runs since the start of the year. I do want to get your thoughts on Hurricane Milton as we're closely watching, that storm down off the coast of Florida, what the impact potentially is for airlines, especially at a time where airline stocks have rallied here in recent months. And we know earnings are about to get underway with Delta kicking off later this week.
Yeah, I mean, Hurricane Milton, clearly a watch item. It'll be a significant hurricane, and we're watching all of our Florida exposure companies on the aerospace and defense side closely and hoping for the best. But obviously, the airlines are most impacted. We're seeing 90% cancellation rates out of Tampa and Orlando for tomorrow and Thursday. The most impacted are the ultra low-cost carriers. So Allegiant has about 40% of ASMs impacted, as well as Frontier is impacted, and so are Spirit Airlines. The network carriers, American, United, Delta, have about 5% ASM cuts. So not as big of an impact, but the low-cost carriers are seeing it. In general, the story of the airlines has been capacity cuts since the start of the summer. We're seeing about 3 points of capacity cut out of the market from the start of the summer till the end of the year, which is positive for yields. Fewer flights, better pricing for the airline industry, which has not seen positive domestic pricing.